everybody, this is Swati Gupta, Chartered Accountant. Welcome to lecture number 18. We will continue to discuss the illustrations of Ind AS 115. Please refer page number 3.48 of ICI module, that is chapter number 3. We will continue from illustration number 31. The previous illustrations are covered in previous lectures, do watch them. We will discuss right now is the volume discount incentive. If you have done any contract with a customer and you are giving any sort of discount or you are being given any sort of discount on reaching any criteria, okay, and that is based on sales, that is volume, okay, so volume discount incentive, that is sales based discount. So HT Limited enters into a contract with a customer on 1st April 2001 to sell product X for rupees 1000 per unit. If the customer purchases more than 100 units of product A in a financial year, the contract specifies that the price per unit will be reduced, will fall down to rupees 900 per unit. Now the question arises how to record this reduction in price, whether the amount of revenue should be recorded at rupees 1000 per unit or 900 per unit. You will get to know this right now in this example itself, okay. Consequently, the consideration in the contract is variable. It is variable because you are not knowing exactly it will be charged 1000 rupees or 900, okay, because it is dependent upon reaching 100 units. For the first quarter, that is 30th June 2001, the entity sells only and only 10 units. It sells only 10 units of product A to the customer. The entity estimates that the customer's purchases will not exceed the 100 unit threshold, since in the first quarter they have only sold 10 units, okay. So they are expecting that the whole financial year total sale will not at all exceed 100 units, and there how they will not reach the target, and thereby they will not be in a position to get benefit of reduction in price. So therefore they must record the revenue for the first quarter at rupees 1000, okay, because there is no expectation of reduction in price. Further, it has been backed up by one important statement. Read it carefully. I will also tell you the meaning of it, the significance of it. HT Limited determines that it has significant experience with this product and with the purchasing pattern of the customer. Thus, HT Limited concludes that it is highly probable that a significant reversal in the cumulative amount of revenue recognized of rupees 1000 will not occur. This means that it is simply telling you that if you are recording any particular transaction in the books of accounts at any certain amount, there should be high chances that it will not be reversed. There are high chances that you will not be required to reverse this amount that you have recorded as revenue. If yes, then you can record that revenue. So here it is telling, since you have just sold 10 units, you are not in a position to get reduced price benefit. So therefore, you should record the revenue at rupees 1000 per unit, okay, and thereby it is highly probable that the significant reversal will not occur. When the uncertainty is resolved, what does this mean? When the uncertainty is resolved, that when the actual figures will be known. At the end of the period, when you will get to know the actual figures, when the uncertainty is resolved, you will not be in a position to reverse the amount that you have recorded, that rupees 1000 per unit. Okay, till now clear? So for first quarter, you will be recording at 1000 per unit, that is 10 units. Okay, so quarter 1, you will be recording rupees 1000 into 10, that is 10,000 rupees revenue. Okay, 1000 into 10 units. Now later in May 2001, the customer acquires another company and in the second quarter ended 30th September 2001, the entity sells additional 50 units. Okay, now so in quarter 2 they have sold another 50 units, that means 60 units. Now they might be assuming that the final sale for the whole financial year might exceed 100 units, okay, because it is expected, because they have performed very good in quarter 2. In the light of the new fact, the entity estimates that the customer purchases will exceed 100 units. threshold for the financial year, and therefore it will be required to retrospectively reduce the price per unit at rupees 900. Okay. Determine the amount of revenue to be recognized by HT Limited for the quarter ended 30th June and for 30th September. If we talk about quarter number 2, see, now you have sold 50 units at the rate rupees 900. At the rate rupees 900. This means 45,000. This means 45,000. Okay. And earlier, if they were recorded all 60 units were recorded at 900, then the difference will be reversed. See how the calculation is done. The entity recognizes revenue of 10,000 for the first quarter. This is quarter 1. For quarter 2, 50 units into 900 less the change in transaction price of rupees 1,000, that is 10 into 100. This price reduction that must have been done, that is rupees 1,000, will be deducted. So 45,000 minus the 1,000 that must be reduced from the previous this means 44,000. So for quarter 1, you will be recording 10,000 rupees as revenue. For quarter 2, you will be recording 44,000 as revenue. Why you have reduced this 100? Because it should be, see, 900, it is like 1,000 rupees was charged and now only 900 must be charged. So this difference 100 must be reversed retrospectively, okay, into 10 units, and thereby you get 1,000 rupees reversal. Okay, are you clear? In case of any doubt, please comment down below, download the app, chat with me. Okay, please don't keep your doubts as doubt. Okay, it is strictly prohibited. Next, measurement of variable consideration. An entity has a fixed fee contract of rupees 1 million, that is 10 lakh rupees, to develop a product that meets specified performance criteria. Estimated cost to complete the contract is rupees 9,50,000. The cost is 9,50,000. The entity will transfer control of the product over 5 years. After 5 years, they will be transferring the control. And the entity uses cost to cost input method. Cost to cost means they will be appropriating this 10 lakh in proportion of the cost. This 10 lakh rupees will be appropriated in terms of the cost. The cost has been completed 50%, the amount 5 lakh will be recorded. The cost further has been added to 30%, the further 3 lakh will be recorded. Okay, it is being recorded as per the completion of the cost incur method to measure progress on the contract. An incentive award is available if the product meets the following rate criteria. If it measures 951 or greater, then 0% incentive is there. If it weighs between 701 to 950 kgs, then 10% amount will be given, 10% of fixed amount, that is 10% of 10 lakh rupees, 1 million rupee, okay, that is 1 lakh rupee. So 1 lakh incentive will be given. If the weight is 700 or less, then 25% incentive will be given, that is 25% of the fixed fee, that is 25% of the 10 lakh rupees, that is 2,50,000. Okay. The entity has extensive experience creating products that meet the specific performance criteria. Based on its experience, the entity has identified 5 engineering alternatives that will achieve the 10% incentive, and that 2 that will achieve 25% incentive. Okay. In this case, the entity determines that 95% confidence that it will achieve 10% incentive, 95% confidence. Okay, probability, you can say probability. Okay, 95% and 20% confidence on 25%. Okay, that the firm will achieve 25% award, the probability is 20%. The firm will achieve 10% award, the probability is 95%. Based on the analysis, the entity believes that 10% is the most likely method. If there are only 2 outcomes, you can use the most likely method. okay, in which the most likely one is recorded as revenue when the estimating the transaction price. Therefore, the entity includes only the 10% award in the transaction price when calculating revenue, because the entity has concluded it is probable that the significant reversal will not take place of the cumulative revenue recognized will not occur. When the uncertainty associated with the variable consideration is subsequently resolved due to its 95% confidence in achieving 10%, there are high chances that they will be achieving 10% criteria. The entity reassesses its production status quarterly to determine whether it is on track to meet the criteria for the incentive award. At the end of the year 4, so for year 1, year 2 and year 3, the criteria was 10%, 10% and 10%. That is 1 lakh rupees, 1 lakh rupees, 1 lakh rupees will be the variable consideration. From year 4 and 5, because there are 5 years. How come you get to know there are 5 years? Because it has been said that the product will be transferred, the transfer control will be done in the over 5 years. Okay, so here at the end of year 4, it becomes apparent that this contract will fully achieve the weighted based criterion. Therefore, the entity revises its estimate of variable consideration to include the entire 25%. So, from year 4, they are assuming that they will be achieving 25% of the criteria. That means the variable consideration will be 2,50,000, 2,50,000. For first year, second year, third year, the variable consideration will be 1 lakh, 1 lakh, 1 lakh. From year 4, it will be 25%, that is 2,50,000. Because at this point, it is probable that the significant reversal in the amount of the cumulative revenue recognized will not occur when including the entire variable consideration is the transaction price. Now, the cost has been given for the year 1, year 2, year 3, year 4 and 5. This cost has been incurred. If you total this is equal to 9,50,000. So, only the bifurcation of per year has been given. If you are applying the input method, cost input method, this means that the 10 million or you can say the 10 lakh rupees revenue will be recognized in the proportion of this cost. This means for year 1 it will be 50,000 divided by 9,50,000. For year 2 it will be 175,000 divided by 9,50,000. Okay, so this is the revenue, fixed revenue. You can say fixed revenue. It will be proportioned in the on the basis of this cost criteria. For year 1, 50,000 divided by 950, this ratio. Okay, now let's go to the solution. See, fixed amount has been given. If you are preparing for the exam purpose, please do watch it carefully. Observe the writing pattern of the answer, the presentation part of the answer as well. And if you are just reading for the professional purpose and application purpose, you do not need to go through and the formats. Okay, you can try your own, unless it is balance sheet and P&L, a set format has been given. Okay, so for solution purpose, the fixed consideration is 10 lakh rupees. The estimated cost to complete is 9,50,000. No issues, this was given in the question itself. Now, the total estimated variable consideration for year 1 it is 1 lakh, 1 lakh, year 3 1 lakh, from year 4 and 5 it is 25% and 25%. Therefore, 2,50,000, 2,50,000. Okay, this is variable consideration. Now, the fixed revenue is 10 lakh rupees will be divided as per the cost, that is H divided by the total cost. Okay, that is this. This means you are simply recording the revenue of 10 lakh rupees, okay, into 50,000 divided by 9,50,000, okay, in the proportion of cost. Simply next 1,75,000 divided by 950, then 4 lakh divided by 950, then 2,75,000 divided by 950, then 50,000 divided by 950. Now comes the variable revenue. We know 1 lakh, 1 lakh, 1 lakh, 2,50,000, 2,50,000. Okay, so this is all clear, and this is being proportionated in the proportion of the cost of each year to the proportion of the whole total cost. Okay, Now what is this cumulative revenue adjustment? See, for example, if this 2,50,000 was to be recorded since first year, okay, and now it is just being recorded till date. Till date the recordation has been 52,000, 1,84,000, this and this. If you sum total this 1, 2 and 3, you sum total these all figure, till date it has been recorded a particular amount. And now if you talk about the variable consideration, it should have been recorded this much. The difference is this 99,370. How come? See, for example, if we talk about 2,50,000, now 95% has been calculated because 9 lakh cost divided by 9,50,000. Why 9 lakh cost has been taken? At fourth year. At fourth year, the cost completion is, see, calculate. This total cost is 9,50,000. So till year 4, you have achieved or you have incurred 9 lakh cost. So till fourth year, your 95% of the cost have been already incurred. So this 2,50,000 revenue, the part of 2,50,000 revenue, 95% of such 2,50,000 must be recorded. Okay, so 2,50,000 divided into 95%. Since the cost is 95%, the revenue should also be recorded 95%. Okay, now till date the cost is have been recorded is, see, add this 5,263, 5,263, 18,000 plus 42,105 and 72. If you add these four figures, you will come to know that it is equal to 1,38,157. So now you should have recorded 2,50,000 into 95% and you have recorded till date 1,38,157 the variable revenue. So the variable revenue, okay, it should be 2,50,000 into 95%. Minus till date you have recorded 138,157. So now adjustment required is the difference between this. The difference between 2,50,000 into 95% and minus 138,157, that amount you have recorded till date. The difference will be recorded as the adjustment. Let's head towards illustration number 3. Management fees subject to the constant. There are some conditions put in. On 1st April 2001, an entity enters into a contract with a client to provide asset management services for 5 years. The entity receives a 2% quarterly management fees based on the client's asset under management at the end of each quarter. Okay, 2% of per quarter. At 31st March 2002, the client's asset under management are rupees 100 crore. This means 2 crore revenue, 2 crore incentive. Okay, management fees is management fees at the rate 2% equals to 2 crore rupees. Okay. In addition, the entity receives a performance based. There are two variable things. Okay? One is management fees and second is performance based incentive. That is 20% of the fund's return in excess of the return of an observable market index over 5 years period. Consequently, both the management fees and the performance fees of the contract are variable consideration. How you will record it? Okay. See, the entity accounts for the services as a single performance obligation because it is providing distinct services, series of distinct services that are substantially the same and have the same pattern of transfer. Okay, the entity observes that the promised consideration is dependent on the market. Okay, the promised performance based consideration is dependent on the market and thus highly susceptible to factors are outside the entity's influence. In addition, the incentive fee has a large number and a broad range of possible consideration amount. See, if there are high number of outcomes, I have told you before as well, if number of outcomes is more than 2, okay, then you follow average method. Okay, average method. See, broad range has been given, then you follow. The entity observes that although it has been experienced similar contracts, the experience of this little predictive value is determining the future product of the market, performance of the market. Therefore, at contract inception, the entity cannot conclude that it is highly probable that a significant reversal would not occur, and therefore it is estimated of the management fees or incentive in the transaction price. At each reporting date, the entity will be doing what? Will be highly identified, that it concludes that it should include estimate of the incentive fees in the transaction price at those dates. This is because it has not been a change in the assessment from the contract inception. The variability of the fees is highly probable that a significant reversal will not take place, and therefore the quarterly management fees is rupees 2 crore. At the end of each quarter, the entity allocates the quarterly management fees for the distinct services during the quarter. This is because the fees relate specifically to the entity's efforts to transfer the services for the quarter, which are distinct from the services provided in the other quarters. Okay, and what about the performance fees of 20%? This is highly probable. You still do not know the figure. Since you do not know the figure, you will not record it in advance. Okay, but whereas if you know the management fees, you will record it in advance. Okay, that is rupees 2 crore. 2 crore will be recorded in the books of accounts. Okay, this 2 crore will be recorded, but it will be appropriated and allocated to the each quarter dependent upon the performance of it. Okay, so at the end of each quarter, 2 crore rupees will be recognized as revenue for the quarter ended 31st March 2002. Next, example number 4. An entity enters into a contract with a customer to sell 10 units of a product for rupees 100 per unit. The customer has the right to return the product, but if it does so, it will be charged a 3% restocking fees. This means rupees 3 will be added for the restocking, or rupees 3 will be returned unit. The entity estimates that 10% of the sold units will be returned. Upon transfer of control of the 10 units, the entity will recognize rupees 903. That is 9 units not expected to be returned into 100 rupees. Okay, and plus the 1 unit that is being expected to return into the 3 rupees restocking price, that is 903 rupees, and the remaining 97 will be not treated as revenue directly. Instead, it will be recorded as refund liability, because you might need to refund it anytime. Whenever it is being returned, you will have to refund this amount, and it is expected that 1 out of every 10 units is returned. So for the 9 units that will not be returned, that are not expected to return, you will record it at rupees 100, and for the 1 unit that is expected to be returned, the 100 rupees that you have received, the 3 rupees will be considered as restocking price, and the 97 will be refunded, recorded as refund liability. Whenever the liability arises, you will reduce this refund liability and pay it off. 1 unit is expected to be returned into 100 minus the 3 rupees stocking price. Let's see the illustration number 34. An entity enters into a 1000 contract with customer. Each contract includes the sale of one product for rupees 50. 1000 total products into 50. Okay. Cash is received when control of the product is transferred. The entity's customary business practices, that is its past and policy business practices, is to allow a customer to return an unused product within 30 days. They can return back the product within 30 days and receive a full amount. See, this is revenue recognition. When you are, for example, doing any transaction with the customer, for example, if you talk about Myntra, if you talk about Amazon, you buy things on it, and there is a period given, for example 10 days, 15 days, where you can refund it, where you can return the product and get your refund back. So how to record revenue in that case? How those company like Myntra and Amazon will be recording the revenue? This is done in this way. when there is a right to return attached with it with a certain time period, the entity's cost of each product is rupees 30. Okay, so the amount that is being expected to be refunded, okay, will be reduced. The entity applies the requirement in Ind AS 115 to the portfolio of rupees 1000 contracts because it reasonably expects that in accordance with paragraph 4, the effects of the financial statements from applying these requirements to the portfolio will not differ materially from applying the requirements to the individual contract within the portfolio. Since the contract allows a customer to return the product, the consideration received from the customer is variable. Therefore, the consideration, since they can receive it, so if you have received it or not, the amount that you will be receiving or that you have received is quite variable because there are high chances that you might need to refund it. Okay, so even after doing a sell of rupees 1000, you are not in a very good you cannot expect it very exactly that how many will be returned, what should be recorded and what should not be recorded. Okay, so 30 is the price. To estimate the variable consideration to which the entity will be entitled, the entity decides to use the expected value method. Why expected value method? Because there are multiple options. Outcomes. When there is more than 2 outcomes possible, you use expected value method. What do you use? Expected value method. And when there are only 2 outcomes possible, you can use the most likely method. Okay, it is also given in the notes portion. So now, since there are many options that how many will be returned, you are opting for expected value method because it is the method that entity expects to better predict the amount of consideration to which it will be entitled. Using the expected value method, the entity estimates that 970 products will not be returned. So 970 products will be recorded at rupees 50. Okay, will be recorded at rupees 50 because no need to return these. The entity estimates that the cost of recovering the product will be immaterial and expects that the returned product can be resold at a profit. They determine the amount of revenue, refund liability and the asset to be recognized by the entity, the said contract. Okay, so basically you will be recording 48,500 as your revenue. The amount that will be treated as cost will be treated as refund liability. Okay, so now 30 products out of, how come 30 products? 1000 products minus 970. 970 will not be returned. So 30 products will be returned. 30 products will be returned. So the amount into 50 will be recorded as refund liability. This is very much clear and similar to the previous example. Now the amount 30, okay, the 30 units and 30 price. How you have got this 30 rupees? Because here in the question, it has been given the cost of each product is 30 rupees. It will again add to your assets. Since they have gone out, they were removed. Okay, the inventory was removed. Now if they will be returned, they will be restocked. If they are restocked, then this 30 amount will again add to your inventory. The sales return will add your inventory. Therefore, the 30 units will be recorded at cost as an asset, or you can say inventory. Inventory return or restock. Okay, restocked. So whatever is very much high possibility that will be returned, the products will be returned. So this is always recorded as separately as refund liability. If converted, then it will be recorded as revenue. If not, then this refund liability will be removed. Okay. Now next, warranties. We have talked about it. We'll see illustration number 35. Warranty. An entity manufactures and sells computers that include a assurance type warranty. If assurance type warranty is there, that means it is not available separately. It is done because of any law and all, just to protect the customer. If it is this case, then it will be governed under Ind AS 37, okay, where you provide the provisions and all, where you account for the provisions and all. Okay. For the first 90 days, the entity offers an optional extended coverage plan under which it will repair or replace any defective part of 3 years from the expiration of the assurance type warranty. Since the optional extended coverage plan is sold separately, it can be sold separately. Go to your notes part, okay. Please watch these videos only after understanding the concepts of Ind AS 115, okay. Only after watching the previous lectures connected to Ind AS 115, okay. So it can be sold separately. The entity estimates that 3 years of extended coverage represent a separate performance obligation. That is service type warranty. So it is selling two warranties, assurance type and service type. The total transaction price for the sale of a computer and the extended warranty is rupees 36,000. Okay, so service type is included in it. Whereas if we talk about assurance type, it is separately recorded as your warranty expense. So your service type are rupees 32,000 and 4,000. Okay. The inventory value of the computer is 14,400. Furthermore, that the computer will be sold out, then inventory will be reduced by 14,400, the cost of the inventory. Furthermore, the entity estimates that based on its experience, it will incur 2,000 in the cost to repair defects that arise within 90 days coverage period for the assurance type warranty. Pass the journal entry. See, so you will be receiving 36,000. You will be receiving 36,000 either in cash or the debtors will be increased by 36,000. Now the warranty cost, the warranty expense or cost that will be incurred in addition when you will be correcting such defects as under the warranty. If you will be providing any sort of service under warranty, this will cost amount approximately rupees 2,000. So 36,000 inventory will trade receivables will be increased or cash, and next expense will be incurred. To accrued cost, warranty cost will be 2,000. To contract liability, the service type 4,000. How come you come to know? Because separate amount is given 32,000 and 4,000. So this 4,000 rupees will be treated as contract liability and the remaining will be treated as revenue. Only the 32,000 rupees will be treated as revenue. And when inventory will go, this is the cost of the inventory, that is 14,400. Okay, that's all for this lecture. We'll continue in the next lecture. See you in the next courses. Till then, take care, be safe, stay tuned. Don't forget to check out the description box. The link for the whole course is given over there. We take our regular classes, regular videos are being uploaded for you, and the course will be completed by the end of September. Okay, it is wholly aimed for November 2022 preparation for CA Final FR. And other than that, even professionals can go through it if they want to have a thorough knowledge and want to have a practical experience for applying each and every Ind AS. Okay, for any doubts, don't forget to download the app from the Play Store. That is Stay Ahead. Okay, bye bye.